Business model analysis. This is a summary of understanding what is a business model. This is an article by Thomas Eisenmann in 2014, published by Harvard Business School. So business model is helpful if you want to understand what is this company all about. If you are starting a company and if entrepreneurship is for you and you have started a company, you need to have a business model. Business model is nothing but a set of choices in 4 different areas. Number 1, customer value that you provide. What are the choices? Why did you choose to build one product versus the other product? So that is, what is the feature? What's the product? What's the offering? What's the service that you're providing? What's the value you're adding to your customer? So that has a lot of decisions and choices. So that is one part of the business model. The second piece is technology and operations. Once you have an idea, you need to build it, and you need technology to build it, and you need operations to scale it, to build it to critical mass that you can serve all of your customers' needs. Third, you need to have a decision made on what is your strategy to go to your customers or go to market. How are you going to get your product to your customers? Building great product does not equal having a product that sells. So go-to-market strategy is how you actually reach your customers. And fourth, what is your plan to profitability? How are you going to make the money, right? So if you can answer areas, all of these 4 areas clearly, then you have a business model. So if you're trying to understand a company, or if you're trying to build your own company, these are the 4 areas that require a lot of choices, a lot of work. So let's get into each one of them. But before that, in a sense, business model is path to economic self-sufficiency. If you can answer all of these 4 questions and all of your hypotheses are validated and tested, then you can actually be self-sufficient economically. You can make profits, and requires a lot of these choices to be made. So once you understand that, in a sense, a business model is a set of choices, you can actually use the business model answers to these 4 different set of questions and build a strategy. So we've extensively talked about strategy, but this is the basis. This is the basis. If you understand these 4 areas and if you have solid answers, then you can actually have a chance to build a strategy. So I've written some of these things in brackets. I'll get to that at the very end. So let's get into each of these 4 areas. So as I said, I'm going to summarize again. Business model, set of 4 choices in customer value that you provide, technology and operations, what is your go-to-market strategy, and path to profitability. If you can answer these 4 areas, then you're golden. You have a business model. And you can, if you're analyzing a company, you can understand what is the company's business model. So let's go into the first one, the customer value provided. So if for any product to be successful, there has to be some unmet need that is not served by any existing product out there. That's why your product or your service is useful. So you need to understand, what is that unmet need of a user, of a customer that you're trying to solve. And you need to articulate it. What is the differentiation that you are providing? Are you building something totally innovative, or are you just giving it at a much lower cost? So that's a choice. Which customer segment are you targeting? Is it a new market that you're building that's not served? Are you going to actually steal from incumbents some of the segments of those customers? So who is your customer? Who? This is the what. And why are you building, right? And so when you build it, when can you launch it? Like, what's your minimum viable product? And what is your roadmap? Once you build an MVP, what is the next set of features that are coming? Can't be that you build something and then boom, done, right? No, it's got to be a set of choices that build on top of those product lines that you deliver. Like Apple built the iPod and then eventually built the iPhone, right? And then the iPad, right? They have value that they're providing. They're improvising on that. And then what are your complements that you need for your product to work? Is your product work on its own, or do you need some of these partnerships to work? When Apple launched the iPhone, they built partnerships saying exclusive AT&T, right? AT&T needed a lot of incentive to build and invest on those data networks that they didn't have. But when they got exclusives, they were able to have the incentives. Those partnerships helped the partners to succeed. So are there complements needed for your whole product to work, or can you work in isolation? So that is customer value. If you can answer each of these questions, if you can make choices to each of these questions, then one of the 4 things you've taken care of, which is customer value. So once you have nailed customer value, the second most important is technology and operations. Once you know what you're going to build, you got to go build it. So what are the questions and choices we need to make? So let's quickly look at that. What activities will you perform? What activities will you outsource? Meaning, hey, I'm not going to be hiring full-time employees. I'm going to have full-time employees do this, part-time employees do that, and I'm going to outsource the rest to some other country. So you need to know who, what, when, right? For those activities. Can you exploit some scale economics? If you build a product over and over, you get better at it. You can have better negotiating power in terms of raw materials. You can actually build it quickly, right? Your learning curve goes down. Are you going to be creating something that's intellectually patentable or intellectual property? So that is valuable, because then you get first mover's advantage. You can actually protect the work that you build. And there could be last mover's advantage too. You could be like, hey, I'm not going to spend all of this money in R&D and developing all of these products. Let this company figure it out, and I'm going to reverse engineer, and I'm going to not have all of those costs going into that research. The downside being they could have patents on that new work that they did, and now I'm all of a sudden on their mercy to use their patents. So there's an advantage, disadvantage over both first mover and a last mover. Can the venture scale rapidly? Let's say the product is super successful. Can you scale? Like if 1,000 people need it, 1 million people need it, can you scale your technology? So all of these questions are a set of choices that you need to reflect as to what are my technology choices, what are my operational choices. And these are some of the leading questions that make us think, how is this company working, or how is my company going to work? All right, once you have good technology, you need to have a go-to-market plan, a plan that your sales team takes to take your product to your customers. It's very hard unless you have a really good sales team to really scale up. So what are the questions for having a go-to-market plan? First, what is the mix of direct and indirect channels that you will be employing? Direct channels are your own salespeople that you employ. Indirect are the people that you don't employ directly. And you can have people who do selling for you outside of your direct channel. And each of them have different margins. What is the LTV and CAC? These are really good terms. Lifetime value, LTV, and CAC, customer acquisition cost. So if you sell a product to a customer, LTV stands for what is the total money that they will give you in terms of revenues from them. So at most, you can spend all of that money to acquire that customer. That is the CAC, customer acquisition cost. So your CAC at most can be LTV. If not, it has to be lesser. If CAC is less than LTV, you're profitable, right? So you'll have to factor in all of the future cash flows, calculate the net present value, and then find out the CAC and LTV for this venture. What is the free channel? What is the paid channel to generate demands? You can generate demand, a lot of demand, by paid marketing, like Google AdWords. Advertising is huge in terms of radio, in terms of internet, in terms of television, in terms of Super Bowl ads, signboards, billboards, right? So paid and free demand generation. What is it that works for you? How are you going to make it happen? What is the shape of your conversion funnel. You will have a customer who sees your ad and then they have to click it and then they have to actually sign up and then they have to actually pay you the money to, and then they have to be retained over and over, right? So what does your conversion funnel look like? And what's your viral coefficient? Like if you acquire one customer, do they bring in any other customer, right? So that's another choice. And how are you going to bridge that big gap between those mainstream adopters who are using legacy products and your early adopters? How are you going to address the chasm between the mainstream and your early adopters? It's going to be some bridge to connect. And is there a huge incentive to scale up very quickly? Because of network effects, it's very hard to steal from the incumbents. So you might have a very strong incentive to aggressively scale up. Switching costs also could have a huge impact for legacy products to keep their customers glued to their products. So there may be huge incentive at play if you are trying to build a product that scales up quickly. And so you have to then factor in, what are my first movers advantage, what are my late movers advantage, and which one there's a higher probability for me to win. So all of these questions are part of your go-to-market plan. Like, what are you going to do? How aggressive are you going to be? Or how less aggressive you're going to be, right? And how are you going to bridge your customers and your want-to-be customers? And the fourth and the final part is the profit formula. Once you have your products in your hands of the customers, you need to figure out how you make and keep those customers so that your product continues to make profit. So you have to figure out the pricing. How are you going to price? You can't give it for free. You have to build, and you have to bill for revenues. Is there going to be some network effects at play? Can you use bundling? Can you pre-install your software? Can you have pricing strategies that support for bundling, for free trial? What are the switching costs for the customer? Remember, even if you offer something cheaper, doesn't mean you're going to be able to steal those customers from your incumbents, because there's a lot of switching costs. Even if you have to, let's say, move from one apartment to the other apartment, if you're renting, it is not cheap, even if the other apartment is cheaper to just move there, because it takes you time, energy, and real money to switch from one apartment to the other. Same for enterprise customers. It's much more expensive to train your army of people to say, hey, we're going to move from this product to that product, we're going to move the data over, and hopefully none of the data actually gets corrupted and everything's fine, right? So there's a lot of switching costs. And what's your LTV? We talked about this. If your CAC, customer acquisition cost, is greater than LTV, lifetime value, probably not worth it. What is your contribution margin, or what is your accountability margin? You spend all of this money, what's the return? What is the contribution that you're going to get? Is it positive? Is it negative? How long it's going to be negative? What are your fixed costs? What is your break-even capacity to cover up in terms of your sales volume that's needed to actually cover up your fixed costs? And at what TAM percentage would you have a break-even? Because if you're going to have a break-even at 100% TAM, probably not a worth investment. And how much upfront investment's needed? And how much incremental investment is going to be needed for $1 of revenue? For every $1 of revenue, how much upfront investment, incremental investment, and ongoing investments needed? That'll help make a decision on investment. So contribution margin, fixed costs, and return on investment. Once you know that, at a given point, you need to find out, how do they change over time? Because hopefully your fixed costs reduce over time, your contribution margin increases over time, and your investment to revenue ratios decrease over time, right? So you have to then factor in your projected growth. How much money would you need? How much working capital would you need? And how deep is your cash flow curve? Basically, in the beginning, you will lose money. but then you'll start making money. So how deep is it? When will you reach the depth of it? And what's the maximum depth? All of these are a lot of questions. And so there's also this really good book called Business Model Generation that's referenced in this article. Basically, it's suggesting to this article really inspires us to think about a startup as not a simple like, hey, I'm going to just build this company. No, there's a lot of things that go into building a company. And so you need to have answers to all of these. But this may also sound very daunting to have answers to all of these questions up front, because a lot of these answers change over time. So does that mean that we should never answer these questions? In this one article, just one article, right? This is not, I've not even gone through this book. In this one article, we had 4 different areas that we looked at, and it has so many questions, at least 50 questions, 40 to 50 questions. And each of them will require time. And there are 2 approaches you can take. One approach being, hey, I'll just figure it out, right? Because things change. If I write down the answers to all of these questions, next day, 50% of them might have changed because I just learned something new. So the other option is you say, hey, I'm going to take a first pass. I'm going to actually write it down, all my hypothesis, all the answers to these questions, at least in few lines. I'm going to spend a day, I'm going to spend a few weeks to actually write this down and do some hard work, maybe spend even a month. Say, hey, I'm going to spend this time to do this work. And then have some of these hypotheses in color coded. Pink could be like, hey, this is too early to think about this idea. Blue could be like, hey, the test is missing. You need to have a test for a hypothesis. Yellow could be, hey, the test exists, but you've not executed it. Green is the test exists for a hypothesis, you've executed it. So then your board will change from pink to green over time. You can actually see what's working. From what I read about Dropbox and other companies from similar articles, they don't spend way too much time on all of these questions to be answered because it's difficult. You will learn a lot. But they look at few key important areas and then they iterate over time. And so for every startup, for every entrepreneur, for every business venture that you're evaluating, you need to understand these questions and be on a constant guard to adapt. Because you need to have multiple business models. One, like let's say a competitor comes in, like a big company like Google comes in to attack Dropbox. What would Dropbox do, right? So there's a lot of these options that your strategies need to change based on different business models, different ideas on how will you adapt. And a lot of this thinking has to go through. As a founder, I think everyone should spend at least a few days, if not more, to go through and answer this. If you're trying to invest in a company too, that's a good one. Understand, what are these hypotheses? Do you understand the company? Can you answer these questions well? If you do, maybe there's a high chance you understand the company well and that your investment is on solid grounds. There's a lot many questions, but these are really good ones to start to understand, like, hey, what is this thing called as a business model and how does it help build the company's strategy? At the end of it, we all have to be very flexible to adapt and change, but this gives us a framework. This gives us some clear way to think about evaluating a company for either our own investments or to understand how the company works or to build our own company, right? So quite a good article. Hope you enjoyed it. Thanks.